Hello, my name is Steve Bigelow with the Candlestick Forum. We finally saw a decision of which direction the market trend will move. After a series of indecisive trading, remember, the Japanese rice traders tell us when you see indecisive trading, whether it's sideways trading or a bunch of dojis, that usually indicates a change of investor sentiment. Today, they told us which way they are moving that investor sentiment, trading well out of this trading range, as well as back below the T-line. Same scenario here on the NASDAQ. Notice how the 34 is a relatively good support and resistance indicator, but this trading range also was breached to the downside, making for a wave one, wave two, prospects of a wave three to the downside. This obviously means we should be orienting our trading toward the short side. And a lot of stocks will go down in a downtrend. However, we're looking for the strongest ones moving down in a downtrend. Our recommendation on QTWO last week was based upon this bearish best friend. The bearish best friend is merely a doji followed by a gap up or a gap down. And also observe where it occurred. This doji harami that told us the buying had stopped, occurred right smack dab on the 50-day moving average, which is where everybody else was watching. That gap down provides a lot of force to the downside. So we are much better off when we identify a trend based upon what signals are telling us versus just merely a downtrend. Notice our bearish left-right combo that closed below the T-line, followed by a bearish doji sandwich, which implied more downside. Our recommendation to buy puts on this one today was based upon the combination, plus you can see how it was rolling over. It failed at this level. It's trading below the T-line. What's our expectation? Wave one, wave three. Again, this is not rocket science. This is just identifying the strong and weak signals, or bullish and bearish signals. In this case, lots of bearish signals telling us there's more downside to this market. Intel, look at your bearish kicker signal that closed back below the T-line. What'd that tell you? The 34 was acting as a resistance level. And once again, we use the high probability factor of the T-line, that if you see a candlestick sell signal and a close below the T-line, the probabilities are extremely strong, you're heading down. So not only did you have a kicker signal, a few days later you had a trend kicker signal, which also implies a lot of downside strength. So even though it's moved down, there's very strong, very good option strategies. We recommended today doing a June 40 37.50 put spread at 39 cents, with the prospect that if it's heading lower, especially to the bottom of this channel, which puts you down into about the $37 range, that 39 cents could now go to the 250 area. So this is more just taking the information we know that creates strong movement one way or the other and taking advantage of it. So when we see something like Moss doing a bearish doji sandwich through an obvious support level that everybody else could be seeing, you can kind of see this wedge formation. But when it broke this level with a bearish doji sandwich, which also implies more downside, that was a pretty good indication that this level was not acting as resistance anymore. I'm sorry, acting as support anymore. Again, the T-line is a very important factor. This is what keeps your emotions out of your trading. We've been short or in puts on Carvana for quite a few months now. When do we cover it? When you see a buy signal and a close above the T-line, which you haven't seen yet. Now, how does this keep your emotions out of your trading? If you're like me and most investors, if you've got a good profit, what do you want to do? You want to make sure you get that profit put in your account, because boy, would we look stupid if we had a good profit and we let it go back to nothing. That is what the T-line prevents you from doing, just taking a profit just because you have a profit. allowing you to stay in good, strong trades. So the T line and the signals provide high probability situations to put you in profitable trades. And it doesn't necessarily mean, so put it this way, if we're in a downtrend in the markets, you're much better off being in short trades. However, that doesn't eliminate being able to identify fry pan bottoms. And why do patterns have multiple benefits? One, because the magnitude of the move is usually fairly strong. Two, we know we can stay in it as long as we don't see it close below the T line. And three, as you can see in ALDX in this fry pan bottom today, they were still trading this positive when the market was off strong. So candlestick analysis just allows you to put the probabilities in your favor or put all the stars in alignment. Right now with this breakdown of the markets, with the potential of heading much lower, now obviously tomorrow's CPI announcement should affect the market one way or the other, but everybody knows the CPI is announcing tomorrow and they were selling it off. So that's what everybody's decisions were. So that'll be it. We'll see you in the chat rooms.